Who actually carries the debt in a leveraged buyout? The PE fund or the company? Most people answer too quickly. Let's follow one simple deal. A PE firm wants to buy a company worth $100 million. It invests 40 million of equity and uses 60 million of acquisition debt. So the company is bought for 100 million, but the sponsor has put in only 40. Now the real question, where does the 60 million of debt sit and which entity records it? That is what interviewers care about. KKR's acquisition of RJR Nabisco made LBOs famous and inspired barbarians at the gate. Think about buying a house. The house costs 100. You pay 40 as a down payment and borrow 60 as a mortgage. You control the full house without paying the full price upfront. An LBO follows the same idea. The sponsor contributes equity, debt funds the rest. The company's future cash flows help pay interest and reduce the debt. Why use leverage? Without debt, the sponsor invests the full 100 million. With debt, it invests only 40. If the business performs well, the return on that 40 can be much higher. But leverage also magnifies losses. If cash flow weakens, interest and principal still have to be paid. That is why a good LBO target is usually mature, cash generative, not already over leveraged, and capable of improvement. Now follow the money. LPs provide capital to the PE fund. The fund invests through an acquisition vehicle often called holdco or bid company. That vehicle, or sometimes the operating group, raises the debt. The portfolio company generates the cash flow that services it. So one deal creates three accounting stories. The PE fund tracks capital calls, its investment, fair value changes, exit proceeds, and LP capital accounts. Hold company or bid company records sponsor equity, acquisition debt, financing costs, interest, repayment, and the investment in the target. The rule is simple. Identify the entity first. Now the entries. First, the fund calls capital from LPs. Debit cash or capital call receivable, credit LP capital. That increases fund capital, but it is not investment performance. Second, the fund invests 40 million into hold company. Debit investment in hold company, credit cash. Cash has become an investment. Third, hold company receives the sponsor equity. Debit cash, credit sponsor equity. Fourth, hold company raises 60 million of debt. Debit cash, credit acquisition debt. When the acquisition closes, the simplified bid company entry is debit investment in target, credit cash. Detailed purchase price allocation comes later. Then ownership begins. The company must generate revenue, convert it into EBITDA and cash, pay interest and reduce principal. Interest is recorded in the entity carrying the debt. Debit interest expense, credit cash if paid, or interest payable if accrued. Principal repayment is different. Debit acquisition debt, credit cash. That reduces the liability. It is not an operating expense. What happens in the PE fund books? The fund does not copy the portfolio company's interest expense into its own P&L. Instead, it revalues its investment in hold company. Portfolio company value less debt gives equity value. That drives the investment's fair value and the fund's NAV. Fair value changes, fund level fees, and valuation or FX adjustments can move NAV. Capital calls, initial funding, and principal repayment do not automatically create performance. Now see how leverage affects equity. At entry, enterprise value is 100 million. Less 60 million of debt leaves 40 million of equity. Assume the company improves and its value rises to 130 million while debt falls to 40 million. At exit, repay the 40 million debt. 90 million remains for equity. The original 40 million is now worth 90 million. At fund level, debit cash, credit the investment at carrying value and record the difference as realized gain or loss. But realized gain is not automatically carried interest. Proceeds still pass through the waterfall. LP distributions and GP carry depend on the partnership agreement. 40 million invested and 90 million returned gives a gross MOIC of 2.25 times. IRR needs one more fact: time. Management may also roll over part of its equity to stay aligned with the sponsor. So here is the interview answer. In an LBO, the PE fund contributes equity through an acquisition vehicle. The acquisition vehicle or operating group carries the debt. The company's cash flows service and reduce it. The fund records its investment and fair value movement. On exit, remaining debt is repaid first and the residual value flows to equity. Remember the order: entity, cash, entry, NAV, exit. Follow that sequence and an LBO stops looking complicated. If this helped, like the video, comment with the LBO step you want next, and subscribe to the Fund Desk.